the moderator of this panel, my dear friend, Nicole Purin, who is Deputy General Counsel from OKX Exchange. The stage is all yours.
Thank you. Thank you very much. Many different angles from the digital asset world into a more kind of traditional space. It's almost as if, you know, the two will integrate at some point or another. So I would love to invite on stage Mr. Bilal Mir, Mr. Apollo Eric, and Alex Fazel. Please welcome our guests on stage. Invite our speakers to introduce themselves, starting from Bilal. If you give us some background about yourself and your expertise in the sector, it would be great for the audience. Thank you.
Sure, Nicole. I run a crypto asset management company called CarterCapital. I founded this company with my partner, Gustavo, who everyone knows in the room. We invest in large cap listed coins and tokens. We do this in a very low risk manner. We aim to achieve only 100% per year, which is a traditional, in traditional markets terms, it's a fantastic return. In crypto, it's regarded as rather low. We are non-custodial in our structure, meaning we never hold our clients' assets. These are kept in our clients' own wallets. We connect externally and implement our strategies within the client's wallet. Previous to this, I was an investment banker in London. I worked for several years at a US boutique investment bank as an emerging markets distressed credit trader. So I do come from the traditional markets world and now trying to, as best as possible, implement what I've learned in the crypto sphere.
Thank you very much, Bilal. And Apollo, please give us some background about your...
Thank you, everyone. My name is Apollo Eric, CEO and co-founder for Bitlipa. At Bitlipa, we are on-ramping the 150 million mobile money users into DeFi and crypto across Africa. We are also facilitating crypto payment and access to capital for small and medium-sized enterprises. Thank you.
Thank you. And Alex?
Hello, disruptors. How are you doing today? Great. My name is Alex Fazel. I'm the Chief Partnership Officer at Swissborg. We're a crypto wealth management ecosystem. We've topped at $2 billion of assets under management. We serve over 750,000 KYC users across the globe and actually are community-centric. That's the most important part. We did an ICO. We didn't get any institutions in. It was fully retail. And so we are built with the community and for the community.
Thank you very much, Alex. So I'll start by asking you a very interesting question about the current state of crypto asset management industry and what are institutional investors' current views on this particular asset class. And then we'll ask all of the other speakers to respond to the same question. So starting with you, Alex.
Yeah, so it's a really good question, right? Like, should you buy equity or should you buy tokens? And I think the fine line is starting to become very blurry in the sense that a lot of the previously only equity type plays VCs are starting to get interested in tokens and are understanding that there is fundamental value. And that's a very important step. And we can talk about how we measure tokens that have real value versus those that are purely casino or gambling type tokens, right? But to me, like, what I'm seeing right now, and we talk to many of the big VCs, is a lot of them are starting to do only token deals. As crazy as that sounds, the more traditional players, like we talk about the conservative, private banks or family offices, they're saying now we want to get into the equity play. But to me, really, the easiest way to see this is I see tokens capturing a certain ratio of all the value that the company has. So not the entirety, right? Not 100%. But it's a really good way to start with a token because let's say you're a fan of Nike, right? You're going to want to buy the shoes. Maybe you're going to buy a jumper. You're going to buy some cool stuff. And everything that's related to the products are kind of connected to the token, right? But if you're talking about the licenses and maybe it's a holding companies with other companies and shares in other different fields, the token doesn't capture that value. So I really see like tokens like a stepping stone for the traditional players to test the things out, maybe dabble with it, play with it, and then go into equity when they really want to have full ownership. So kind of the other way around of what's happening today. I know it sounds weird, but that's my view.
So that's very interesting. So we're seeing like an evolution, and perhaps more maybe risky appetite on, from institutional investors from your perspective. So, which again, it's certainly a trend to look out for. What about you, Apollo? What are your thoughts on this particular sector?
So if you look at crypto assets, and I think there's need for clear distinction between cryptocurrency and crypto asset, because currency is something you use for buying something or a medium of exchange. But a crypto asset could be a jewelry, IP could be a crypto asset, and even something like, physical asset like farmland with trees on it could be tokenized and placed on the blockchain and made tradable. And I think the angle that most institutional investors are taking is diversification of portfolio. So if you look at the current market, you have cash in dollars, and you're talking about double-digit inflation. You're talking about stock market that is crashing. So how do you maximize your returns? And I think most of them are looking at crypto asset as a way to maximize the returns and just diversify completely their portfolio. And if you look at things like real estate, you can't be able to tokenize real estate and bring in investors and give them exposure. And at the end of the day, actually, in the developing emerging market, you'll have some very, very good returns. And I can foresee more and more institutional investors getting into crypto asset as a way to just boost their underlying performance and at the end of the day, really get some good return in a negative environment like this. Yeah.
No, I agree with you. I think that there's certainly more and more interest, more and more appetite. Of course, it's still, still gradual progress because there's a level of conservatism, as well. But I think there's definitely a lot of potential, especially as this market becomes, in my view, more and more mature. And now this brings me to Bilal, and what are your thoughts on this?
Yeah, my thoughts are that institutional investors are certainly adopting crypto more and more as an investable asset class. About 12 months ago, the total market cap of listed coins and tokens was over $3 trillion. At that point, we did see a huge wave of interest amongst institutional investors in crypto assets. And it's something that Carter Capital experienced, personally. We had a lot of institutions inquiring with us. We still do. In some ways, they act very similar to retail investors, which is as the valuations are increasing, they become more and more interested. But actually, in the last 12 months, there have been big developments on this front in terms of institutional adoption. We've seen institutions like Goldman Sachs offer crypto investment products for the first time. BlackRock, the world's largest asset manager with over $12 trillion under management. Remember that the current market cap of crypto is less than 1. So this is more than 12x the entire crypto market. They are starting to offer crypto investment products to their institutional clients. Fidelity also. So institutional investors are definitely making moves towards crypto. As the technology advances and adoption continues to increase, adoption of crypto and blockchain technology is growing faster than internet adoption at its peak. So as the adoption around the world continues, it's clear that institutional investors will continue to develop further interest and deploy more capital in the space.
No, absolutely. I mean, this is very, very interesting, and I agree with you. I mean, I'm seeing it myself. I mean, I come from traditional finance and moved into the digital asset space, and we are beginning to see more and more of the great opportunities that are emerging with institutional investors. So my next question to the panel is whether now, I mean, we're currently in a bear market in the digital space, but is this now an advantageous moment to deploy capital in the digital assets world, or is it better to be more prudent? What is your intuition on this? Starting with you, Bilal.
Well, Nicole, it's always a good time to invest in crypto. I'm going to say that. Now it's actually a very interesting moment. I'm very positive as to the state of crypto markets at the moment. On the listed side, there are two things that really drive valuations in crypto assets, both on the upside and the downside. Number one is technological advancement and increases in adoption. As we just discussed, that is continuing to increase. We can see that the rate of adoption is increasing. On-chain, a number of wallets and users is going up. Some volumes are down in niche sectors like NFTs and metaverse, but holistically, if we look at big institutions, Nike was mentioned, McDonald's we were discussing earlier today. Gustavo mentioned that they have submitted various metaverse patents. As these institutions come in, technology increases, that is moving forward. That is not stopping. That's very clear. The second element is liquidity. If we look around the world, we're seeing central banks around the world increasing interest rates. That is to combat inflation, which, as we have all experienced firsthand, is going up around the world, including in the UAE. As as interest rates increase, this essentially removes liquidity from the system. Crypto, as a long-duration, high-risk asset, this is one of the biggest casualties among global asset classes when liquidity dries up. Institutional investors remove their allocation towards crypto first, before real estate, before stocks, and certainly before bonds. But as we are starting to see now around the world, interest rates are beginning to decline, or at least plateau. We're seeing severe economic damage occur in Europe and the US and other developed markets. That means we are getting closer to interest rate decreases and eventually money printing again, which we've gotten used to in the last several years. As we tick closer to this certainty, we're starting to see crypto markets stabilize and beginning to increase very slowly. So markets are a forward-looking indicator. The view that you see in any market right now, equities, real estate, crypto, this is not the view right now. This is a forward-looking indicator. Where are we going to be 6 months, 12 months ahead? And if you take the view, Nicole and audience, are we right now in a better or worse economic condition than we will be in 12 months or 24 months? I would say almost certainly we're in a worse condition now. Things are going to improve coming forward. Therefore, it is highly likely that these valuations will increase, considering the use case and adoption is considering to increase also.
Yes, absolutely. Hopefully, there will be an upward trend. But, I think that at the same time, as we are seeing, in the context of, bear market, there is a period of stagnancy, and then eventually, there will be a upward fluctuation, and it's a question of really capturing the trend and understanding when to pick up on the opportunities. What about you, Apollo? What are your thoughts on the topic?
Well, I think it's always a good time to put money in crypto, because as a trader, you can trade the market downwards or trade it upwards. You can ride it either way. And for me, I look at projects from a long-term point of view. And what you want to ask yourself as a fund or as an institutional investor is, what is the intrinsic value of this project, in the long term? And if there is value, which means they're solving a real-world problem, then it doesn't matter these short-term fluctuations. Remember, only in January, the market was at peak. It's just like 8 months, 9 months, and we're talking about the bottom, and it's going to recover. So I think that in the long term, crypto recovers and rebounds in a very, very big way. And you don't know exactly when it's going to bottom. So right now is a good time to, I would say, to go in and just manage your risk, because if you have a good project, the founders are people you can trust, and the community, every crypto community that is successful has a community around it. They're loyal and believing in the project. I would say put your money in crypto right now. Because
of course, everybody has to, whoever decides to participate in this industry, they need to take well-informed advice. They need to, decide whether it's right for them or not. But I think that also because of all the developments in the market, there's probably going to be a consolidation and a natural selection of the, only the best projects, only the best players, similar to what happened with the .com back in the 2000s periods. So I think that probably at the end of the year, this market will be very different. It will be much maybe slimmer, more robust, and will provide greater certainty for investors. Perhaps, let's see. Please, Alex, your thoughts.
So, what is the best data point to really understand timing? If you look at AAA, which is one of the best data aggregation platforms in crypto, after Statista maybe, they will tell you that as of today, if you measure adoption based on the number of Web3 wallets versus the number of Web1 users, we're in Q4 2017. Now, why is that date absolutely essential? Because the dot-com bubble was between 95 and 2000. So that's the best reference point you can get, because this is just another bubble that will have many winners coming out of the bubble. But what is the most important lesson? So in terms of timing, we know that we're very, very early, and we all know here that crypto as an asset class, I like to call it an industry or even a world, because it's more than an asset class, is actually the most asymmetrical return asset class out there, without a single doubt. Everyone knows that. Would you agree or not that the most exponential returns will come from crypto? Yeah? Now, asymmetrical return also means that you need to minimize the downside, correct? And what is the best lesson we've learned with regards to the dot-com bubble? How many of you think that you would have invested in Amazon in the early days? I guarantee you less than 1% would have. It's a beautiful question. Wouldn't you have loved to invest in Amazon in the early days? It was fucking hard. Sorry for my French. It was really hard, because out of 105 of these dot-com companies, only 4 survived. So you had one chance out of 100 to actually pick Amazon, which no one believed in at the time. So what can we learn here? We know timing is right? Even in terms of technical analysis, if you look at Fibonacci retracement levels from all-time high, the timing is right. But we need to learn that diversification is key. So really understanding to measure. Who here has blockchain infrastructure tokens? Please show me your hands. Who here has CeFi or DeFi tokens? Show me your hands. Who has nothing? Show me a dance. Sorry, that was the lamest joke I could have pulled off. I lost all my credibility. But I do want to stress that if you have 5 infrastructural plays, layers 0 to 1, 2, just diversify. Don't be one of those tribalistic guys who go all in Terra and get wrecked. Don't go all in Cardano. As much as you love this stuff, that's the best lesson we've learned through the dot-com bubble and Web.1. Now we're Web.3. Diversify your portfolio by understanding how to value each token.
Thank you very much. That was very, very insightful. Lots of interesting statistics. I love it. So really the final question, because I think we're running out of time, is the following. So from your perspective, in order to attract institutional investors, clearly you have to have in place a lot of robust risk management processes to reduce risks, essentially, because that's part of the also internal approvals when it comes to deciding factors whether to invest or not. So yes, so starting from you, Bilal, what do you think are the key factors, the key processes to be implemented in order to really create a robust risk management approach to attract institutional investors in this sector?
Yeah, I think institutional investors is a very broad term. So each institutional investor has their own investment mandate. There are certain institutional investors that do take a lot of risk, and they would engage in highly levered investments, small cap, micro cap investments. So you would need to understand individually what is each investor seeking. But it's been mentioned by the two gentlemen here, Apollo and Alex, that risk management is very important. So understanding what is your maximum risk on each investment that you're taking. What is the maximum risk that your entire portfolio is facing at any given moment? And really providing, very good analysis on why you're taking positions in certain assets. Carter Capital, has a basket of around 20 to 25 assets it understands very well, we believe in, and we allocate our clients in a portfolio across these assets. We also bring in a very, very heavy amount of macroeconomic analysis. We're looking at money supply, global bond yields. That influences our investment decision very heavily. if you give institutional investors categoric, clear to understand reasoning as to why you're taking positions, I think that's what they want to hear. Institutional investors are really less interested in the 1-day or 7-day fluctuation in a token price, the latest technological upgrade on an obscure blockchain. That doesn't really move markets as much as, you know, bond yields, money supply, and adoption. So making these clear cases to institutional investors is what we do and is working rather well.
Thank you.
For institutions, I think one of the biggest bottleneck is regulation. They want to go into a market that is well regulated because you're talking about consumer protection, consumers of financial services. And that's an area that is very, very gray in crypto right now. So that needs to happen in a good way that doesn't stifle innovation. But also, I think it's important to look at things like adjudication of disputes in these matters. That is not there as long as regulation is not there. So that needs to come in. But also beyond that, I think it's important for us to look at how do we manage risk for institutions, because we're talking about $1 trillion investment funds bringing in money into crypto. So how do they avoid risk if an asset is not performing so well? How can they track it? How can they be able to even, you know, report on their taxes? And these tools need to be built in, you know, so people need to use AI and machine learning to be able to build, you know, programs that can help institutional investors to be able to effectively manage their risk. So I think those two needs to come into play, and we'll see more and more money coming into the space from institutional investors.
No, definitely, and I think that there are already third-party providers that are developing a lot of these systems, solutions, topologies to enable the growth of the institutional sales sector in the digital asset space. Alex?
Yeah, so when I go to Bond Street and I have to talk to these family offices and private banks and like, what the hell is this stuff? Obviously they speak much more eloquently and elegantly than I just mentioned, but I literally try to just speak their language, simplify things to the core basics. So I'll give you guys an example. If we're talking about large cap, as we were mentioning earlier, because obviously the micro cap are scary for most institutions, already the large cap are scary. So let's just talk about how to value large caps rather than talking about the micro caps, because we use different systems at Swissborg. But I would just tell them, layer 0 is like a desert. Nothing has been built, right? It's literally like a desert. A layer 1 is the beginning of the roads, the core infrastructure. And a layer 2 are fast lanes that help you go faster to a specific direction. So when you speak like that, they can really start picturing a digital world. They're thinking, okay, now I'm starting to understand what digital assets are. So really using simple language and connecting with things that they're familiar with and the unfamiliar, that really helps me in terms of communicating to them. I know it's not exactly answering the question, but I think it's really important that us geeks simplify our language sometimes and just break it down to the bare basics, because that is educating the institutions is the first step in getting them to be involved.
No, and you want to be building trust, you want to be building bridges, and you need to be able to communicate in the same language. But it was extremely insightful responses. I'm not sure if we still have any more time for additional questions from our audience. We've got Gustavo, very persuasive. Let's get him to ask.
For instance, that what will trigger the new valuation of cryptos is liquidity, and you mentioned liquidity. And that means money printing. Unfortunately, that's what it is, right? I've been asked people to pay me beers when this is going to happen because I've given timings. The first one happened a week ago when your own country, the UK, just printed 62 billion euros, to pay for the pension fund's margin calls. Remember, this just happened a week ago, all right? Those 62 billion euros came out of nothing. They just printed them. Actually, they didn't even print them. They just put them in computer lines in the Central Bank of England. So my question to you, Bilal, is when do you think the European Central Bank is going to do the same? Because obviously hacking interest rates is not working. We all know that. And there's about to be a revolution in France. You all know what's going on. There's 30% of the gas stations that have no petrol today in France. So when do you think that the European Central Bank will start printing money again? And then the US next. What's your guess? Starting by Bilal to everybody.
That's a good point, and you were the first person to be saying that the developed market central banks would begin printing money again. You said this in Europe. We're already seeing actually, stimulus through the back door, where they're providing fuel subsidies in Germany and France to certain members of society. So I think, a broad stimulus package from the European Central Bank is imminent. I would expect, not before the end of the year necessarily, but Q1 2023, I expect that to happen. And the US, it's a very well-trodden path. There are cycles of money printing and money money being removed from the system. That is going to happen. It's a factual comment that it will happen. And I'll just make one more comment that you made about 63 billion pounds being clicked out of nowhere into existence. If anyone asks people in the audience, what is crypto backed by? What is Bitcoin backed by? Just make that point that 63 billion pounds was just clicked into existence one morning. $13 trillion has been created since the onset of COVID. And just ask whoever asks you that question what that was backed by. The answer is nothing.
I'm fundamentally against printing money. I don't think you can print time. I don't think you can print energy. People need to earn, save, invest. That's how wealth is created. And I think it's a very, very wrong path we're taking in terms of printing money to inject liquidity into our markets. We need to let the market correct. There's so many investment mistakes which have happened because there's free liquidity.